All right, Steve, stay with us. Let's bring in ADP Chief Economist Nela Richardson. If I was going to look for a report to sort of just confirm what recent reports have been indicating, I guess this would kind of be it. Any major divergences from what you were expecting, Nela?
No, this has been a very modulated cool down. The labor market is striking the right note at the right time to be consistent with that gradual easing that's consistent with the 2% inflation target. The concern, and this is one concern we have, is how concentrated these job gains are. As Steve mentioned, they're in the service sector. The leisure and hospitality sector is carrying 40% of the job gains this month. And so while we think that this is a gradual cool down that we all expected, I'd like to see the hiring be more broad-based than it is now.
Nela, the details in the numbers, does it make you think that the progress on inflation that we've seen recently, can that continue, or could we get stuck?
Leisure and hospitality, the labor market more broadly has really helped the Fed. It's helped the Fed be patient. It's kept its pace and then gradually cooled again at the right time. But if you look at those paychecks and the fact that we've broken 5% year over year growth with this highly strategic, individualized match data set, that is important. The last time we were under 5% was in August of 2021. So this pay growth, the fact that it is slowing in a modulated way, is so important for the Fed. I think it is the most important data point right now.
Would you change any of your expectations for what we're going to see on Friday based on all the details here?
I think it's harder to predict what's going on in the BLS report. One, government jobs have really been strong in that report the last couple of months, so will that continue? Healthcare has been, again, picked up very strongly in that report. This is a sector that is not as sensitive to interest rates, so we may see that again. But what you really, I think, is worth paying attention to is the unemployment rate. How cool is cool enough for the Fed, and how fast is that unemployment rate going to rise, or is it going to stall? I think that's the key question going into Friday after we all have a break on Thursday.
Steve?
Hey, yeah, Joe, I just want to point out what you're talking about with Nela about wage gains. The rate of decline, and this kind of highlights the Fed's problem. It's true of inflation overall, and it's true of wages. It's really flattened out, right? So you went from 5.8 or so back in October of 23 down to 5 real quickly. And in the last 4 months, we've gone from 5 to 4.9. So there's not been all that much progress. It's going, as Nela said, in the right direction, but it's kind of like what's happened with the overall inflation rate, which is you had these big drops in the second half of 23, and now the drops have moderated. And what's interesting, though, about what Nela's saying, I don't see, Joe, how you get, if these numbers are right, 150,000, there shouldn't be much rise at all in the unemployment rate from there.
Nela?
Yeah, just to continue with that line of thinking, we did see percentage point declines last year in year-over-year pay growth for job stayers. We're not seeing that anymore. It's edging down. And our contention when we look at the data is it's likely not to get back down to pre-pandemic levels. The economy has shifted. The demographics are not in the favor of seeing year-over-year pay gains around 2 or 3%. So if you think of a world in the future where year-over-year pay gains are elevated, it does make the job harder for the Fed. They can't rely on basically flat year-over-year gains in some industries. That's not happening.
All right.